When the market looks at Rivian today, it sees a cash-burning EV maker that's struggling to scale. People see the massive factories, the heavy capital expenditures, and the brutal pricing wars with Tesla and the legacy automakers. But if you look under the hood at the company's latest financial data released in July 2026, a radically different picture emerges. There is a hidden economic engine operating inside this company, and it's completely transforming how we should value the business. So, to understand the real tension driving Rivian stock today, you have to look at the massive disconnect between what the market is terrified of and what the numbers actually show.
42%. That is the shocking number that completely flips the script on this company. See, while Rivian has historically lost money manufacturing physical cars, dealing with all the usual supply chain headaches and assembly line bottlenecks, they just posted a staggering 42% gross margin on their software and services segment in the second quarter of 2026. This isn't some distant future projection. This is happening right now. They are literally subsidizing the incredibly difficult business of bending metal with a highly profitable business of writing code.
What we're watching is Rivian executing a massive, strategic pivot toward a software-defined vehicle ecosystem. Yes, they build premium electric adventure vehicles, like the $70,000 plus R1T pickup and R1S SUV, and obviously they've got the highly anticipated mass-market R2 platform rolling out soon. But you have to realize, those vehicles are effectively rolling supercomputers. To understand Rivian's true valuation, you have to look past the hardware and examine the high-margin recurring software and licensing services that those vehicles enable.
So let's dive into part 1, the hidden software engine, and how Rivian actually plans to win this space.
To get how big of a deal this is, look at the contrast in how these machines are built. Traditional legacy platforms are defined by extreme electronic fragmentation. I'm talking about companies like Ford or GM relying on 15 to 20 separate electronic control units, or ECUs, sourced from external third-party suppliers. It's a patchwork quilt of software that is notoriously painful to update. Rivian, on the other hand, went with a clean-sheet zonal network architecture. Think of it like upgrading from a dozen separate remote controls to one master smart home hub. They consolidated everything into just 7 zonal controllers running their own in-house real-time operating system called SafeRTU. By doing this, they eliminated 1.6 miles of physical wiring per vehicle. That cuts weight, slashes manufacturing costs, dramatically lowers warranty points of failure, and gives them absolute control over seamless over-the-air software updates. It's a massive, generational technological advantage.
And that generational advantage? It's exactly what is driving these high-margin recurring revenue streams. First up, you have the Volkswagen joint venture. In the second quarter of 2026 alone, engineering and licensing services billed to Volkswagen contributed $308 million. That was 60% of Rivian's entire software and services revenue for the quarter. Then you have FleetOS, which is their commercial fleet management SaaS platform. They charge operators about $50 per vehicle per month for route optimization and predictive maintenance. Keep in mind, they have over 40,000 electric delivery vans deployed with Amazon on this network, which creates massive switching costs. And for consumers, they've rolled out Autonomy Plus, a $49.99 monthly subscription for advanced driver assistance.
But look, the software is only as good as the hardware running it, right? Back at their Autonomy and AI Day in December 2025, Rivian dropped a major reveal: their transition to custom in-house silicon. This is the first-generation Rivian Autonomy processor, or RAP1. It's a custom 5nm chip delivering 1600 TOPS of AI compute, which essentially means it can process massive amounts of autonomous driving data incredibly fast. By vertically integrating the silicon, the perception stack, and the large driving model in-house, Rivian is achieving a level of computational depth that legacy competitors just can't match without totally ripping up their existing supply chains.
This technology arms them with a massive weapon as they attack a staggering total addressable market. The global electric SUV market is projected to reach over $4.3 trillion by 2030, but the real prize? That's the midsize electric SUV segment, which is growing at a nearly 33% compound annual growth rate to hit nearly $1.7 trillion. This is exactly where Rivian is aiming their upcoming high-volume R2 and R3 midsize platforms. The R2 standard configurations, launching in 2027, will start at a highly accessible base price of $44,990. So they are taking this premium, high-tech, software-defined ecosystem and pushing it right into the absolute core of the mass market.
All right, moving to part 2, the Q2 2026 evidence. Let's stack the market's fears up against the hard financial reality.
Just look at the composition of this massive double beat. Total revenue came in at $1.658 billion. That's a robust 27.2% year-over-year increase, beating consensus analyst estimates by almost 11%. Software and services surged 37% to $515 million. Now focus on the consolidated gross profit. Last year in Q2, they posted a $206 million gross loss. This quarter, a positive $179 million gross profit. That is a massive $385 million turnaround, driven entirely by that 42% margin software segment offsetting the heavy lingering costs of ramping up the physical R2 production line. Adjusted earnings per share came in at a loss of 47 cents, which was a nearly 30% beat over Wall Street's expectations.
And the momentum isn't just in the financials, it's right there in the product pipeline. During the earnings call, founder and CEO RJ Scaringe explicitly noted that early customer interest and conversion weights for the R2 launch edition were meaningfully above their own internal projections. Because of that incredibly strong demand, management actually raised their full-year delivery guidance to a range of 65,000 to 70,000 units. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed.
Unsurprisingly, Wall Street was forced to react to this reality check. The stock responded with an aggregate post-earnings pop of about 5.7%. But even before the earnings print, the smart money was taking notice. Just a few days prior, Piper Sandler issued a significant rating upgrade, moving the stock to overweight with a $20 price target. They specifically cited Rivian's expanding recurring software services, a clean start to the R2, and a substantially de-risked balance sheet.
Okay, part 3, the qualitative scorecard. It's time to measure the actual underlying quality of the business. Synthesizing the notebook data, the business earns a blended quality score of 6.3 out of 10. The strengths here are undeniable. Revenue quality scores an 8 out of 10 because of this highly successful shift toward predictable high-margin software services. Growth outlook is also sitting at an 8 out of 10, fueled by the massive R2 expansion and a major partnership with Uber to deploy up to 50,000 autonomous robotaxis. But you absolutely cannot ignore the weaknesses. Profitability and track record both score 4 out of 10. Despite achieving a positive gross profit this quarter, the overall business still posted a GAAP net loss of $833 million. They are burning heavy cash as they navigate a highly capital-intensive manufacturing scaling phase. So this 6.3 score essentially paints a picture of an operationally de-risked technology platform that is still heavily constrained by its ongoing cash burn.
Now, all of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, which are quality businesses built to compound for years; hidden gems, which are under-the-radar names with asymmetric upside; and dividend hunters, providing durable income with the fundamentals to back it up. Premium also includes Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this explainer. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
All right, part 4, our 5-year scenario framework. Let's map out the hypothetical outcomes through 2031.
Now, before we look at the math, a quick reminder. This is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios, but we need a mathematical way to evaluate the stock's potential trajectory. Based on the July 30th, 2026 closing price of $16.83, in our high case, weighted at a 15% probability, the implied share price reaches $92.75, which is a massive 40.7% annualized return. Our base case, carrying a 60% probability, targets $30.88, a solid 12.9% annualized return. But we must respect the downside risk. The low case, weighted at a 25% probability, models a severe collapse to $2.21 and negative 33.4% annualized drop. If you want to dive into the full detailed model behind these numbers, you can find it for free at flash.stocksentinel.ai. Let's break down exactly what has to happen operationally to hit these targets.
For the high case of $92.75 to actually materialize, execution has to be literally flawless. First, the R2 platform must quickly hit its target production run rate of 4,000 units per week at the normal facility without any bottlenecks. Second, their greenfield plant in Georgia must complete construction ahead of schedule, smoothly drawing on a $4.5 billion conditional Department of Energy loan to scale capacity up to 300,000 units a year. Third, the Uber partnership has to accelerate, successfully deploying 10,000 fully autonomous R2 robotaxis across 25 cities by late 2028, unlocking $1.25 billion in milestone funding. Financially, this scenario requires reaching $38 billion in year 5 revenue with a highly profitable 12% operating margin.
In our base case of $30.88, we're assuming steady, grounded execution. The R2 platform ramps steadily, allowing the company to reach gross margin break-even by late 2026, exactly as guided. The Georgia factory begins vertical construction in 2027, and the Volkswagen joint venture continues to perform, stabilizing those recurring software and services revenues. Operationally, this drives $25 billion in year 5 revenue at a 6% operating margin as automotive scale efficiencies finally absorb corporate overhead. We factor in ongoing share dilution here, bringing the share count up to 1.75 billion, and apply a reasonable 2.15 times EV to revenue exit multiple.
But we have to look at the other side. Here is the devastating low case that would drive the stock all the way down to $2.21. The R2 platform suffers severe, costly production bottlenecks at the normal plant. Because of those delays, capital costs spiral out of control, forcing the company to delay the Georgia facility and ultimately forfeit access to that critical $4.5 billion DOE loan. The Uber partnership stalls because they simply can't clear the technical hurdles in the Level 4 autonomy software stack. In this world, year 5 revenue stalls out at $9.7 billion, operating margins stay deeply negative at negative 15%, and the company is forced into massive, highly dilutive equity raises that absolutely collapse the valuation multiple.
Which brings us to Part 5, the existential risks. What could actually break this thesis?
The absolute biggest, most pressing threat right now is scaling the R2 manufacturing. Look, recent restructurings dismantled internal pre-delivery quality inspection teams. If they suffer widespread component defects, that would permanently damage their premium brand reputation. Then there's customer concentration. Amazon accounts for roughly 99% of their commercial electric delivery vans. If Amazon decides to delay or reduce their commitments, the commercial segment's economics are instantly devastated. Add in the macro sensitivities. High interest rates are crushing consumer vehicle financing right now, and buyers remain highly sensitive to price, just as legacy OEMs and Tesla aggressively slash costs.
And then you have external reputational risks. In July 2026, federal prosecutors indicted 2 former Volkswagen engineers for conspiracy and securities fraud related to insider trading of Rivian stock right before the official joint venture announcement. Now, this doesn't directly implicate Rivian's corporate entity, but it is a glaring reminder of the complex operational and reputational risks associated with relying so heavily on massive multinational corporate partnerships.
Ultimately, though, the risk comes down to balance sheet tension. Rivian burned through $1.19 billion in operating cash in just the first half of 2026. Management will point to a massive war chest, over $14 billion in pro forma available and targeted capital. But here is the catch. Much of that $14 billion is targeted capital, like the Uber funding and the deal loan. Those funds are contingent on hitting incredibly strict technical milestones. If they miss those milestones while cash continues to burn at this rate, they're going to face a severe liquidity crisis.
Which brings us right back to the central tension of the story. Rivian is absolutely no longer just an EV company. They are a software-defined ecosystem, generating 42% margins on code and custom silicone. But the harsh physical reality of automotive manufacturing still stands directly in their way. Here are your 3 key takeaways. First, the technological moat built on zonal architecture and custom silicon is very real and actively generating high-margin revenue from giants like Volkswagen. Second, the Q 2026 data proves they actually have the software leverage to achieve profitability on a gross basis. But third, this entire thesis hinges on their ability to execute the mass-market R2 manufacturing ramp without crippling capital delays. The number one thing you need to watch next is their sequential delivery rates and R2 margin performance in the second half of 2026. The real question is, can Rivian survive the brutal realities of bending metal long enough to let its brilliant software engine take over the world? If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.